Hey guys, it's Nick. Today we're going to talk about a very important part of finance, how to invest during a bear market. This was an especially tough week in the stock market because of the interest rate hikes that happened on Wednesday. The Federal Open Market Committee agreed that they should raise rates by 75 basis points. And although this was the expected amount, it did take me a little bit by surprise because I was thinking that 3 was the magic number for these large rate hikes. Turns out they needed more. Inflation was stronger than we were hoping it would be, and so the Fed actually does have to be stronger about their rate hikes. What this means for the stock market is that it dropped by 3.3%, which costed investors over $1 trillion this week. Yes, the federal government is very powerful indeed. $1 trillion were lost this week because of their decisions. But what can we do to protect our portfolios from these interest rate hikes? So there's several different things that I've written down here on my notes we're going to discuss and illustrate to you guys here on the big screen. But before we do that, I'd like to ask you guys to like and subscribe. It helps my channel out so much to beat the YouTube algorithm, which is quite challenging to conquer actually. So how do we protect portfolios from bear markets? So the first step is that you have to avoid knee-jerk reactions. Selling can be as much of a mistake as buying at this point because who knows what is going to happen in the market in the short term, right? Perhaps stocks decide to soar as soon as you sell them. That's happened to me countless times and it's very annoying. So you have to be willing to think before you move. So what I'm trying to say here is that if you're sitting on the sidelines, you're not investing your money during this bear market, you're going to potentially miss out on the rally that's coming. And so we have to be prepared for the early stages of recovery because it could be quick. Now, this is not to say that a rally is coming because for all we know, inflation could continue to get worse and the interest rate hikes might not stop. But what we should do is look at the past because over the last 60 years, the S&P 500 has delivered over 9% annually. There are certainly down years, but the up years make up for it by a long shot. If you look at this picture here that I drew, you see that the stock market moves in waves. It goes up and down, but the down periods are shorter on average than the up periods, and the up periods outdo the down periods so that it nets a positive over the long term. That's why I'm saying it averages 9.5% annually. And as you can see, this blue circle here on the right, that's where we're at right now. The market's been falling. It's just been going down and down, and it feels like it's going to keep on going down. But if we look back at history, it has always turned around at a certain point when the government, for example, can't continue to raise interest rates, or when inflation decides to cool off, or when, another example, hedge fund managers decide to buy a ton into the market. All these different factors can cause the stock market to start climbing back up again. And over the long term, I suspect it'll rise again. Another thing that I'd like to point out is that bear markets do not last forever. So keep that in mind, guys. Bear markets do not last forever. As a matter of fact, you see each of the dips that I drew here. The average dip is 9 months long, and the average rise is over 3 years. So let's use our brains here really quick. If the average bear market is 9 months long, and we started falling in January, then what does that mean? It means that on average, the market would start rising in as early as September. So, all right, perhaps this was a bigger than normal bear market. However, since we've extended past the average, it means the odds are already for us seeing a rally soon. So I do suspect that this bear market is not going to last forever. As a matter of fact, it may start ending in 2023. Another tip I have for you guys about bear market investing is to revisit your goals and your risk tolerance. Something that I love to tell my friends is that the longer your time horizon, the more risk that you can and should take because the market goes up over the long term. We know that, it's a fact. But what we do not know is what's going to happen next week, next month, next year. So all we can do in the short term is to keep investing consistently. The more we add to the market, the more we will get when we're ready to cash out. And what better time to invest than right now while everything is on a discount? Discount, that's the key word. Imagine that you're at a clothing store and you see that the clothes that you want are 30% off. Aren't you going to buy it? This example goes hand in hand with what's going on right now. Stocks, good stocks, are 30% discounted. Why don't you go for it? Perhaps you feel like you don't know enough about the stock market. Well, that's where I can help. All you have to do is subscribe, reach out to me, do any sort of thing like that, read a book, and you'll be more ready than you've ever been for this rally. But I have to drill it into your heads. The more you invest now, the more you will have later. And you don't have to buy the riskiest stocks, guys. You have to be strategic about this. Make a portfolio that balances risk and return. There are investments that are not as risky as others. For example, you don't have to put all your money into Nvidia stock or something crazy like that. You can split up your portfolio into bonds, into real estate, into some commodities, stocks, of course, but preferably you're looking for predictable assets. What I mean by that are companies that are delivering consistent returns, that are consumer favorites, ones that are obviously not going to go anywhere anytime soon. One of the companies that I'm seeing all the time as I drive down the street is Costco. I mean, just take a look at their gas stations. It's always crowded. And why is that? Because they offer a few cents discount on their gasoline. It's absolutely amazing. But it's those type of companies that are the ones that are going to survive the test of time. And so whenever those type of companies are discounted, you have to grab them. And that's what I'm talking about. You have to aim for predictable assets because it is those ones that are going to survive the bear market and continue to see the sunny days up ahead. I'm sure I've said this already in this very video, but there's lots of opportunity out there in the market right now. But it's only for those who are prepared, for those who know what they're looking for and are willing to jump into it. That's all I have for today, guys. Thank you so much and have a great rest of your day.